Welcome to the Investor Coaching Show, a podcast to help you get an insider's view of the financial world and escape common investment traps. We look at the financial news of the day and help you make sense of it so you can relax about money. And here's your host, Paul Winkler.
And they welcome. Is that long enough for you, Evan?
Totally.
just enough to be different.
I had to set down my air guitar.
Oh, I thought you were just going to be mimicking and mocking me. Yeah, okay, Paul, you're just going to start the show the way you always do. Investor Coaching Show, Paul Winkler. Okay, yeah.
Hey, there is trust
Whatever.
and consistency.
Oh, wow, I like that. You know what? That's so true. The sun comes up.
There you go.
I mean, within a couple...
If it rises in the west some morning, I'm going to be worried.
And if I start the show differently, you're going to be even more worried.
There you go. Full moon tonight, so all bets are off.
Is it really?
Either tonight or last night. It's pretty full.
It was bright last night. Yeah.
It was last night.
Oh, thank you.
It was bright. It was very bright.
Because I was so distracted by it, I kept staring. I almost crashed.
You were out there howling at the moon, weren't you, Leviticus?
Yes. How did you know?
I heard you. Okay, so yeah, I think that there's more than just Leviticus howling at the moon that's
There you
weird
go.
lately. There's a lot of weird stuff going on right now. It must be Halloween.
Well, that and, it's just, there's news, important news, I'll even use the term, on just like every front in society and culture right now. I mean, it really is a busy time in terms of noise for the market.
I think that's so true. I mean, you look at, Congress.
Yeah.
You hear, oh, man, they just shot themselves in the foot for, because they got somebody in there. Yeah, yay, they got somebody in there.
Right.
Oh, boo, they got somebody in there that's really conservative, and everybody's going to hate them. What?
Vince is leaving. Oh, no. Oh, good. And we're moving into Gaza. Well,
Yeah,
I mean, it's just,
that's good.
It's
No,
creating
bad.
noise
It's good. No,
on
it's
every
bad.
front. Interest rates, inflation. It would be a tough time to be an investor that doesn't use our philosophy right now. I would just think you would be a mess.
Yeah, I think that's so true. So, the level of angst. But then again, there was something interesting you'll find. Which is so screwed up. I was like, I've got to use this for the radio show. I have got to use this for the radio show because it is so... A few weeks ago, I don't know if you heard that there was this thing I did. It was from Advisor Perspectives. It was how financial journalism was failing its readers.
I recall something about that, yeah.
Okay. Yeah, so I did a little segment on that, and I said, here, this is so true. I agree with it. And they were talking about how financial journalism just fails its readers big time. And you look to the media sources, and why is it we know that the media fails us in every other area, but we somehow think with investing it's going to get it right, And I think, wow, yeah, of course of course they're going to get this wrong as well,
Yep.
and they do in just a brilliant manner. So, anyway, they're talking about how they're failing, and investors are going out there looking for information because they want to self-educate. And, the problem is you think that you're getting this objective source, and you just are not.
Right, yeah.
When it gets down to the media. And they've got to get your eyeballs glued to the screen. And, they're talking about how, they use the example of Wayne Gretzky, which I use. Gosh, I've been using that one for 20-something years. I'll never forget my first really bad audio tape that I did. This is pre-radio show days, right? So I did this audio thing, and I'll never forget. I have one of my friends,
Smoke
Susan.
signals of one of your early shows.
Oh my goodness! So Susan, one of my friends, she was a dear friend. We used to work out this gym, and I met her, and we became really, really good friends and everything. And we would talk all the time. And she goes, and still to this day, she brings up, Paul, you remember that first audio tape that you did? It was an educational thing. And I was like, Susan, just be quiet, will you? and it was because it was really bad, Paul. It really was.
But we've all grown since then.
So any of you that are, think, man, I really want to do this. I would really like to, younger people especially, I'd really want to get good at this, but I'm just no good at it. recognize that nobody's good at anything when they first start.
Right.
It's a lesson of life, right? So I used the example, though, in this thing of Wayne Gretzky. And I said, Wayne Gretzky used to have this thing about hockey. Why was he such a great hockey player?
Yeah.
He was not skating to where the puck is.
Right.
He's skating to where the puck is going to be.
Right.
And, that was the thing about investors. They think that they're skating to where the puck is going to be when they invest, and they think that they're getting ahead of the curve. No, you're not. It's just,
right.
You have no clue. But that was, kind of what this writer of this article was saying that the financial media is trying to do.
Mm-hmm.
We're going to tell you what's going to happen next and what to expect based on what's happening in Congress and what's happening in China and what's going on, in Russia versus Ukraine. And then you got, of course, good grief, India, industrialization of India. Yeah. And then you've got Congress, then you've got the president, and then they've got things saying, hey, prognostications that if Biden just gets a better vice president pick, he can put this one out of the park, right?
Right.
And you go, what?
Yeah.
I mean, and then you got people trying to use interest rate predictions, what's going to happen there. So, anyway, I got a lot of stuff on this. Well, this article caught my attention. You'll love this, Evan. Who are you calling dumb money?
Uh-oh.
Everyday investors do just fine. Now, what do we say that everyday investors are actually doing?
They're underperforming by about 600 basis points.
Yeah,
6%
which is
or so.
6% is, and it's not minor.
No.
It's not minor. So this says Jeff Beckman knew he wouldn't get rich. I almost hate using a person's name because I'm going to lampoon him. Working for a nonprofit. So he invested in the stock market. I'm not going to get rich in my job, so I'm going to invest in the stock market and get rich. Okay. Well, the reality of it is, this is something I always teach, is that you don't use the stock market to get rich. You use the stock market to preserve wealth as best you can is the idea behind it. Now, for nearly 4 decades, Beckman has steadily contributed to his employer-sponsored retirement plan, allocated almost entirely to stocks, and he bought shares of blah, blah, blah. He's talking about some stock he bought the shares of. And he says, quoting him, if you're too conservative in your approach, you may outlive your savings. And I would agree.
I would agree with that. Yeah.
I think it's a fine statement. Good. Yeah, excellent. Wall Street has long derided amateur investors as unsophisticated market participants. Well, good reason. I mean, you look back at history, and the first one that I had ever heard where really this was talked about is, remember Kennedy, the patriarch Kennedy in the late 1930s? You ever hear that story, Evan?
I'm going to say no.
Okay, so he was getting his shoes shined.
Oh, yes.
You remember that story? Okay.
Yes.
Okay, so basically Kennedy is getting his shoe shined, and the guy that's the shoe shine guy is, and this is 1929,
right
before the Great Depression, before the stock market just plummets, goes, hey, he's talking about investing in stocks, right?
Yeah.
And of course, Kennedy goes, oh my. The shoe shine guy is talking about, it's like us driving around, being driven in a Uber car, and the person's talking to us about Bitcoin or, something like that. And of course, Bitcoin now, goes up and it goes back, and it recently had this increase in value, and you go, oh, look, this is really wise. No, it goes up and down based on supply and demand.
Quick question.
And you have, yes.
Okay, so yesterday I was at the grocery store. There's Bitcoin machines? I've seen a Bitcoin machine in the grocery store.
You sure that wasn't the coin counter?
No, it said Bitcoin. I should have taken it. I'm going to go back to it today and take a picture of it.
Yeah, well, just whenever. Yeah, at your convenience. I mean, seriously, Bitcoin, are you kidding me?
No, okay. I'm dead serious.
Well, there are new ETFs that are doing that as well, right? Yeah, that was announced. They've got new. Okay. Well, you can make a lot of money on that, being the person that sells the ETF. You
Or
can
the
Thank
person
you.
that
I'm
sells
in
the
the wrong
machine in the
business.
grocery store.
putting it together. Of course you can. You can make good money on the one. And yeah, well, you know who made all the money with the gold rush? It was people selling the pickaxes, and you know they were the ones that made all the money.
Yep.
But anyway, so you know Wall Street's long derided amateurs, investors, and unsophisticated market participants prone to buying high and selling low. But the typical individual investor's long-term mindset, I love long-term. What's your definition of long-term? And penchant for risk-taking has proved fruitful in the technology-driven market of the past decade. That's long-term. And for a lot of us, yes.
Right.
A decade is a long period of time. Defying the dumb money caricature. Now, this is the same thing that happened in the 90s, lest we forget. You know, literally the tech run-up started. I remember I bought my first laptop computer. I literally sent in life insurance applications back in my deep, dark days of being a life insurance agent in 1989. Mm-hmm. And, you know, we were moving off of DOS, you know, basically disk operating system, and we were going to Windows-based stuff, you know, in the early 90s. So you look at when tech run-up started happening, it was then.
Yep.
You know, and I think this also looked brilliant until tech went down 80%.
It was great until it quit working.
Yeah, it was really great, you know. It was like my electric car. No, I don't have an electric car.
Right.
It was great until I had to take a long trip, right? You hear, you know, the information about the electric cars that their distance that they're going is, I mean, huge. It's not a small percentage. Less than what they actually were purported to go.
Oh, no, I missed that.
Oh, yeah. I mean, it's a high percentage, like 50% less capacity for distance, something like it's really bad.
Well, yeah, this is probably
in cold weather.
We can come back to this topic, but there was, in looking through some of the stuff the last couple of days, it sounds like several manufacturers are starting to back off on EV kind of across the board.
They really are.
Which probably makes sense, but it was interesting just seeing how widespread that move had become.
Yeah, the profitability is challenging because they have these cars sitting on the lots way longer than they ever intended, is what's going on. And then all of a sudden you find out, I mean, think about it. You know, we all know it, that if you grew up in upstate New York, like I did, you know that batteries are challenged in the winter.
Right.
They're challenged. I mean, it's, you know, getting them to hold the charge and actually have the be able to turn over your engine when it's cold. It's not just a function of how cold the engine is. You know, you can help when you heat the block. You know, this is what we used to do. Man,
yeah, my
driving cars in the that was not for wimps.
Well, my stepbrother lives in Alaska, and you know they plug them in and just heat them like
absolutely
outside the store.
That is absolutely yeah for sure. So it says that the average individual investor, their portfolio has risen about 150%, since the beginning of 2014, according to the investment research from Vanda Research. The S&P 500, that beat the S&P 500 roughly over that period of time. Now, this is just it. So why did this happen in this particular case? Well, they concentrated very heavily on technology companies, these people that happen to get it good. Well, what are the most recognizable companies that you might invest in out there? I mean, if I said to you, we do this, right, Evan?
Yep.
Now, hey, just name some companies. Now, you know, pick a stock, any stock, and people will typically go, Amazon, Apple, Microsoft, and you go, they're naming all tech stocks, you know, because that's the stuff that's recognizable. And of course, if we look at recent history, those are the companies making news constantly, and the companies are choosing you. You're not choosing the companies.
Right.
Right? See, you know, and what we mean by that is when we think of companies, we just don't think of companies that we hadn't heard of, obviously, for obvious reasons.
Yeah.
You know, so anyway, what happens is we look at this and we go, well, diversification, you look dumb when you have markets like this. You look stupid when you're not concentrated and a few companies are doing everything. It's like 7 companies, the Magnificent Seven, have given us all the return of the S&P 500. Just 7 companies that are all tech companies. And, that we have a saying that's called everyone's a genius in a bull market. Well, when we talk about professional investors and we look at the quote-unquote supposed smart money, and we talk about, gosh, even the pros can't get this right. What happens is that they can't. It's like, and they talk. They give a stat in the article. Professional money managers often have a hard time beating their benchmarks. Over the past decade, 86% of large cap U.S. equity funds have underperformed the S&P 500, according to S&P Dow Jones indices. And if you look at 15 years, that's just 10 years. You look at 15 years, you get up to 92, 94%. But here's the thing. It's, you look at these people and you go, well, they outperformed the S&P 500, but they did it doing something that professional managers are like, I don't think this is a really good idea. And they can't do it because basically you can. You can. You could actually, if you use a sector fund or something like that, it's a really bad idea, but you could. But they actually diversify more. So, you look at it and they have underperformed over that period of time. Well, they haven't done as well as these amateurs because they were more diversified than the amateurs.
Yes.
Right?
Yeah. To me, there's 2 things actually at play in that article. And with the stats that you just read was the inherent claim of, the uneducated or the Main Street investor, whatever term that was they were using.
Uneducated.
Is maybe not so bad after all. You hear that, well, that means the professionals are great. That's kind of inherent in that claim of, well, we're good, they aren't.
Well, that's a good point, yeah.
And the stats you just said is, well, 90% of us don't beat our benchmark anyway.
Right.
That's
so you're not so great
not
either.
Not too good either, yeah.
But they're beating the S&P. And the reason they're beating the S&P is they aren't as diversified as the S&P is my point.
Right, yeah.
So you look at that and go, wow, they're not as diversified. So when the inevitable change in markets comes, then they are crucified when that happens. Because then they are in an undiversified position and they've got nowhere to hide when that comes crumbling down.
Right.
Just because it hasn't happened yet doesn't mean you ought to sit there and go, well, you know what? My house hasn't burned down yet. I don't need homeowners insurance. I haven't had a major auto accident yet. I haven't had a disability yet. I haven't had, fill in the blank yet. Therefore, I don't have to do anything to protect myself. Right. That would be just as illogical. So the last part of this, I'm going to save for after the break because I think that it would be fairly short, but I think it's worth talking about. It's another assumption that they're making that I think is really bad. Thanks for tuning in to the Investor Coaching Podcast. Now, you may be one of these people that's been listening and realizing, wow, investing, there's a lot more to it than meets the eye, and financial planning, tax laws constantly changing, and recognizing that maybe you might need some help in this area, but you don't want just anybody to help you out. So we have 10 offices in the Middle Tennessee area, and everything that we do is fee only. We align our interests with your interests. So you can get an initial 15-minute phone call with any one of our offices just by going to paulwinkler.com/call. That's it. Every one of the offices is run by somebody with 20 plus years experience. They're all degreed planners. They all have academic backgrounds in investing, and you can get the help that you need. So if you want to set up a complimentary phone consultation, just go to paulwinkler.com/call. And we look forward to seeing you soon. So back to this issue with who you calling dumb money? Who you calling dumb? Everyday investors do just fine, according to the Wall Street Journal. But of course, as we just talked about, they are doing fine over a very short period of time.
Right.
And they're doing fine by not diversifying. And that's why people don't diversify, quite frankly. Sometimes people don't diversify because they think they can hit a lick and maybe catch up. And the reality of it is maybe they're behind on their savings and they want to try to hit a lick to get a little higher return to make up for lost time because they didn't do that well. But guess what? The laws of thermodynamics can catch up with them, and things kind of go south in a heartbeat when markets change, and you're not diversified, and you don't own those things that have held up. In times, like if you look at downturns, typically not the companies that have been high flying this year are not typically the types of companies that hold up very well during downturns, quite frankly.
Yeah.
And we haven't gotten into that. We haven't gotten the R word yet from anybody.
They're pretty dependent on capital expenditure and growth and all that.
Yeah, for sure.
Stuff.
So we look at this and we say, okay, so that's one thing. They've got, lack of diversification, and, we got a 10-year period. Oh my goodness, that's just forever. I feel sound like a Valley girl.
Oh my God.
It's so grody. Isn't that a word? Isn't that a word? Is that what they use, Nick? Okay, I'm just looking at you. I need some help, man.
Sorry, I'm a little bit distracted.
Well, you've been fixing my my equipment over here while we've been talking.
I'm trying to.
Well, you did a great job. It's working now. Okay, so anyway, it's a wonderful thing having technical people around you. So if we look at this, we go, okay, so that's one aspect. But now here's the other aspect of it, Evan, is that they had Robinhood, and you asked during the break, how did they come up with this data?
Right. We have the studies that we use, Dalbar, tracks actual flows in accounts. I mean, thousands and thousands of accounts.
Yeah.
And so I was curious, did they just take a snapshot of, okay, here's what people own, and then they back tested it 10 years, but very rarely does an investor hold something for 10 years. I was trying to figure out how they even came up with that return number.
Yeah, it's interesting because I remember a study that was done in an Eastern market. I can't remember exactly which one it was, but what they did in the research is they actually got a hold of data from the trading platforms, and they actually found that the investors were getting really abysmally bad results. And what happened is the trading platforms stopped putting that information out there. They just cut the study off. They didn't give the data anymore is what they did, which is really smart. If you're dependent upon, your livelihood is dependent upon people trading and buying and selling, and then all of a sudden you show that, like if you're dependent upon selling cars,
right,
and all of a sudden you start giving out data about how many people are killed in the car that you sell.
Exactly.
It's not a really good idea. Marketing, I think it's just maybe a little problematic. So we look at that and go, wow, okay, so they stopped putting the data out there. Well, in this particular case, the only paragraph that I actually saw that really gave me an indication where they got this data from on how well the individual investors were doing, quote unquote, was that they had Robinhood Markets created an index tracking the 100 most popular stocks amongst the roughly 23 million users, is what they said in here. And they were talking about mega cap stocks. And if you look at the most recent period in time, and historically, where would we expect the least return long run is mega caps, because really, really big companies don't like to pay a lot to use your money if they can get by.
Yeah. I mean, theoretically, they're safer, and you would expect lower return investing in a safer company. To me, that paragraph is a great example of both familiarity bias. If 23 million users all concentrate around the same 100 stocks, and herding bias.
I was going to say yes.
Same deal. That just proves the point.
Yeah, certainly. And the other thing that they did is this, which is very common. You think about it. This is common. Robinhood users tend to, quote unquote, invest in what they know and use. And this is a person that was head of investment strategy at Robinhood and a JP Morgan Chase veteran of about 2 decades. So this person has kind of seen what people tend to do. They tend to buy what they know, not recognizing that, that Warren Buffett quote was, he knows companies in a whole different way than you or I would. He actually knows how they're run, what the management is, buys the companies, because you hear about him as a person that having outperformed markets when now he doesn't anymore. But back in the day, he would outperform because he would go and get on the board of directors and he'd turn the company around. and do whatever he could because he had that much money. But in the early days, he was taking quite a risk, and he really did. He was one of those people that got hit a lick, so to speak, right? So they're buying in what they know. Now the thing is this. Here is the quote from the person that does this. You ready? Ready? This is what a person might be saying. This thing that I use is so good that I just know the company wants to pay me more to use my money. Now that's objectively absurd.
Right.
That somebody would say that a company I use their stuff, and you know what? Their stuff is so good. I know that they want to pay me a lot to own their stock.
Right.
You would never come to that conclusion. And yet people don't think about it, that's the conclusion that they are actually coming to in this type of scenario where they're buying something that they know and that they use. And because here's what people think. Well, I know it and use it, and thereby what happens is because I know it and use it and it's really good, I know other people will like it, know it, and use it. And since they will like it, they'll buy their products more, and that should make them more profitable and make their stock go up more. But what they're not recognizing is stock prices are looked at and determined based on forward earnings. In other words, what we expect earnings to be. It is the stock's price is the present value of the future expected earnings. And that information that they got a good product and people know it and they use it and they like it is built in to the stock price. So it's not that you're actually going out and buying anything because in the future, all of a sudden, voila, people are going to become brilliant and they're going to catch on and they're going to pay more for the stock. That's what people think, but that's not the way markets work. It's just based on a fallacy on how markets work. So anyway, who you calling dumb, money? I don't want to call him dumb because that's not nice. But I'm going to say just maybe ignorant.
Mind. There you go.
Ignorance isn't stupidity. Ignorance is you just don't know something.
Yes.
And there's no sin just not knowing something. There is a sin, maybe, of learning something.
There's consequences of not knowing something.
Or there is a problem if you kind of know the truth and you willingly go against it, and then you have been logically convinced that it doesn't make any sense. And, once you know what prudent is, as I always like to say, then you might want to do prudent. Hey, this is Paul Winkler. Hope you enjoyed today's edition of the Investor Coaching Show. You want to learn more about what we do, go to our website, paulwinkler.com. You can watch some of the videos there, and if you're not already a client, you can set up a free initial consultation. Until next time, I'm Paul Winkler, reminding you that I believe that more educated investors are more confident investors, and confident investors are more successful investors. Have a great one. Advisory services offered through Paul Winkler, Inc., an SEC-registered investment advisor. The opinions voiced and information provided in this material are for general informational purposes only and not intended to provide specific advice or recommendations for any individual. To determine what investments are appropriate for you, please consult with a financial advisor. Paul Winkler, Inc. does not provide tax or legal advice. Please consult your tax or legal advisor regarding your particular situation.